Thanks for the attention. We still have guests coming. Well, good afternoon, ladies and gentlemen. Welcome on a beautiful Friday afternoon, although, the weather could be better. Welcome to Avari's inaugural Investment Roundtable, a serial event with many more to come. And my name is Ching, and I'm the host for today. Our company works with brands like Avari to help amplify their brand visions. So I'd first like to acknowledge the traditional owner of the land which we stand on, the Wurundjeri people of the Kulin Nation, and to pay my respect to the elders, past and present. We're very lucky to have two experts with us today to speak on the commercial property market, in particular industrial assets. We have seen that industrial assets have been very popular amongst investors thanks to the record low interest rate as well as the booming market from e-commerce. So we'll have plenty of time for Q&As in the end, but also there's a Slido slide where we can type in questions. I'll just show you guys. So here, if you scan this and put in the event code, you can type in the questions as you may. Also, just a bit of a housekeeping. If you could please put your phones on silent while speakers are doing the presentations. Thank you. The toilets are just at the back, behind the big glass wall, and the fire exits are just, towards the gate. So our first speaker today is Alex Dimou. Alex is the National Director of the Property Services at NAB. Alex joined NAB having already spent a number of years in roles which have required high-level valuations expertise in commercial and residential property, including large-scale residential and industrial subdivision developments. These have included positions at flagship valuations firms Chartered Kramer, WBP Property Group, and Armstrong Biggs. He also is a certified practicing valuer, an associate of the Australian Property Institute, and a chartered valuation surveyor of the Royal Institute of Chartered Surveyors. A special thanks to Peter Lucas, Commercial Real Estate Director at NAB, and Patrick Sean, Senior Business Banking Manager from NAB, joining us today and supporting us. Thank you very much. So first I'll hand it over to Alex.
All right, thank you very much for having me today. It's an absolute privilege to give you a bit of an update on what we're seeing in the industrial market at the moment. No doubt there is plenty of excitement in what's happening in all property aspects at the moment, which is definitely seen a bit of a trend towards the industrial and very, very different to probably where we were sitting with industrial a number of years ago. So I'm happy to go through the slide, and as we sort of mentioned, there'll be plenty of time for Q&A at the end as well, so happy to take those questions at a later time. Probably just what we are seeing in the industrial market across Australia, $18.2 billion in industrial sales across the country. When you do look at that in the Melbourne, we're looking at volumes exceeding $6 billion. So it just shows you how much appetite there is for industrial property at the moment. When you look at some of those previous records of $2.5 billion, you can see there how much of the sentiment towards industrial has really changed from a lot of those traditional retail office spaces as well. And also, triple the previous 10-year annual average. So again, plenty of stuff during COVID was still being constructed, and we're still seeing a lot of that coming to market, and a lot of planning still for things to come to market as well. No doubt, the majority of that industrial market is really around that west and southeast corridor. Just due to two things, probably mainly just due to land and also the land availability, but also accessibility to a lot of those airport transport links, etc. So that's where the majority of it's been, and that's nearly 80% of that has been, and we're still continuing to see a bit of a trend in and around that. I'm sure if anyone's gone for a drive out in the western corridor, a lot of those housing developments are now being surrounded by a lot of the larger industrial sort of sites as well. yields, when would you ever thought an industrial yield would be as low as that? And when you're sort of looking at that now, record lows of 3.6%, it wasn't very long ago where you would not even look at an industrial property if you didn't see a double-digit yield. And to see that compress even further by nearly a full percent over the course of 2021, when we were all in lockdown and we couldn't leave our homes, it's absolutely staggering to see. The appetite for that type of industrial asset has continued to go from strength to strength. So again, to be able to, when you reflect, and I was going to put a slide in there from 4 or 5 years ago, we were talking about some of the sales that I'll touch on later. We're looking at sort of the 9-10%, and a lot of them had very, very strong tenants, blue chip tenants in there as well for long-term leases, and that's a very, very different dynamic to what we're seeing in the industrial market at the moment. We're definitely seeing more and more examples of the prime assets selling under that 4% yield, which has been, and that's across all precincts, which again has been something that has been really, really interesting to watch as well. And we're definitely starting to see further competition in yield compression from the beginning of 2021 in some of that secondary asset as well. So it's not only in the past, it was always that the primary asset that was, performing relatively well, and then as you sort of got to your secondary stock, we're starting to see that drop off quite substantially. That's not the case now. There's plenty of people, potential buyers looking at that primary stock, and whoever's missing out there, that on-flow effect on those secondary product is seeing those, seeing some strong results in that secondary market as well. Again, over across the country, we've continued to see industrial, so it's not just the story of Melbourne. We're as low as 3.25% in Sydney at the moment, which, again, just really does show you that it's not just a Melbourne-driven or a certain sector. We're seeing this across the entire national market in industrial at the moment. Yeah, where's all this coming from? And that's just really around the gross take-up that we're seeing across the, we alluded to before around the e-commerce boom. That's where a lot of this has been driven through. And again, as we sort of touched on, most of that demand is around the western and southeastern corridors, which takes up for around 3/4 of what was taken up in 2021. When you sort of look at the rental growth during that time, as quarter on quarter, to see that increase by 2.2% and year on year of 4.1%, it's just showing you that now this is where really people are having to pay what they need to get involved. It's almost like the old retail story where you want it to be close to, anchor tenants. You want to be close to someone else that's in the location. A lot of people now are having to pay heightened, rental growth is seen an increase just due to the buyer demand and the market more generally. Where we've seen majority of that growth has been southeast. The reason why you see southeast is because it is limited in comparison to the west. There's still plenty of land out in the western corridor, where that's going to see continued surges in that type of market. Nearly 13% growth in that market is absolutely staggering result. But as I mentioned, it is due to the supply. There's definitely more supply in the western corridor. Still plenty of land to come to market to develop, where the southeast are obviously a little bit more limited to some of those industrial estates as well that are coming to market. Yeah, industrial. Where's all this new supply coming from, and why do we have it? It probably gives you an idea that there's such a robust demand now at the moment of nearly 62% pre-committed. That is an absolutely staggering result for industrial property, and that is why it's not only a story of 2021 or 2022. It's just that the developers and the product is not enough to service the actual supply at the moment. And that's just to have that kind of pre-commitment levels in industrial, even in the boom times of offices in a lot of the in the CBD fringe, we weren't getting that type of commitment. So it gives you an indication of where all this supply is coming. I know a lot of people drive around, they think, why is there another shed coming up here? Why is there another one coming up here? It's just due to the commitment that's already been provided on a lot of this stuff. Well, you can see there, all-time high, 1.2 million square metres of new industrial stock delivered in 2021. And that will continue to be at a very elevated level into 2022 and beyond. Due to that reason, as I mentioned before, the pre-commitment levels will continue to be very strong in this sector. Again, unfortunately, sound like a bit of a broken record, but the western and southeastern corridors are definitely seeing the benefits around that, and you're seeing nearly 3/4 of the take-up being in those sort of markets, and again, that's really the reason why we're seeing even some tenants moving out of a lot of those northern corridors, etc., and are starting to look at other more modern, suitable products, product type for themselves to move into and take advantage of as well. You can see there between 2022 and 2025, and that's what we expected. This is what's already in planning, and this is what's already in the pipeline. Is nearly 500,000 square metres of additional e-commerce dedicated logistics space. That is the absolutely number one driver of where all this where this demand is going at the moment. So again, just gives you a really good idea of not only what has come to market over the last 2 years or so, but I guess what's projected to come into play in the next 3 years or so. Industrial land. Again, starting to see some really good records, and I'll show you an example of that shortly as well. And it's really around that scarcity of that developable sort of type land, and the premiums that people are having to pay to get a lot of this land acquired. Whether it's potentially for a little bit of land banking, or again, if you've got a pre-commitment of a nice big anchor tenant in there, people are taking the plunge, paying a little bit overs potentially for land. But that's been all absorbed at the end of the day anyway in the end product. When you look at the land rate for 5,000 odd square metres, it's up nearly 30% year on year. So for anyone that's following the residential market, that probably gives you a bit of an indication that's moving in parallel to some of that type of stuff. And even when you're talking about 1.5 hectare lots, some of the bigger stuff, again, it's still holding true at that 30% mark, again, supporting a lot of the e-commerce, large bulky goods sort of type distributors as well. When you look at the land rate from a precinct level, the greatest uplift we've seen, again, is at that southeast, because if you can get it, you'll have to pay a little bit of a premium, just understanding it's a little bit more of an established market. Again, quarter on quarter to see that increase by just over 10%. And for the larger 1.5 hectare lots, people paying at 6.3% quarter on quarter is definitely it continues to be a strong result there. And again, from the west, showing some very, very strong growth in a very, very short period of time. We're talking about quarter on quarter here, and that's really been something that we've tracked really closely into 2022 as things have started to get back to a little bit of normality in the Melbourne market more broadly. I think it's always good to look at graphs, and it's always good to talk and look at numbers, but ultimately I think where the main, gives you a bit more confidence is some of the sales that we're actually seeing, and some of the key notes, acknowledging, I guess, the people that are here today. This is probably the segment that most people are probably looking there. One here in Altona North, $13.2 million. Time of sale, nearly $600,000 per annum, and the existing lease set to expire in August 2024. So I guess the reason why I'm sort of highlighting this, even for a sale like that, $13.2 million, 4.5% yield, you're talking about a tenant that's not a blue chip tenant. It's not anything that's that solid in so many words. You've got something that's ending in August 2024, so there's no extension of that. Previously a type of property like this, as I was sort of touching on at the start, no one would be looking at anything sub 10% on this type of property. But even knowing that there is a tenant locked in for a longer period of time and having various options that are available, people are consolidating, taking advantage of this, and potentially land banking, but also acknowledging the e-commerce boom and knowing that they're probably going to find another tenant if this person wasn't to exercise that as well. So they're the type of investment decisions that people are making at the moment, compared to where people were, especially in industrial. We're making, we're definitely looking for that longer term stability in an asset before making that sort of purchase. So again, just a very good example there. This one here sold very, very recently as well, $16.8 million, sold only a couple of weeks ago. 100 inquiries, and that was genuine. Speaking to these individuals, that wasn't just a number that they threw around. They had a lot of different super funds. They had different private investment companies, individuals, obviously high net worth individuals. Initially had been offered in the range around $14 million. So again, we never really saw an underquoting of properties in the industrial market, and now we are seeing people that are just willing to pay whatever they want, and it's absolutely a bidding frenzy at the moment to get hold of good quality assets. And that's probably why I'm trying to highlight at the moment is this is where we're seeing a lot of the drive, and it's definitely a little bit unique to see the industrial market acting in such a way. But again, gives you a very good indication of the type of people. And when you talk about one of these large assets, there's not another 99 properties that are available on the market tomorrow. So those same 100 people that are interested in that property that only sold a couple of weeks ago, you can, for argument's sake, you could say there's another 99 parties out there looking for a similar product out there, and that's where that supply just can't keep up with that type of demand, whether it's from a leasing perspective or from a purchaser's side as well. Another one just in Dandenong South, and another one here at office to warehouse around 14%, sold for 4.1. But even some of this secondary stuff that I sort of spoke about initially, throughout there, you're looking at a yield, disclosed yield of 3.62%, which again is absolutely staggering, considering that, again, you're not talking about something that's locked and loaded. You've only really got a couple more years left of that tenant being there. But this is the type of property where you're getting some sub 4% yields, definitely in that sub 5 mil space as well. And that's really similar sort of stories I sort of just touched on with some of that 10 plus mil sort of type product as well. But another very good example of something relatively new, hassle-free, still quite a bit of depreciation in it, obviously, as well, and definitely something that people are taking advantage of. This is probably it gives you just highlight some of the land transactions that we're seeing and what we're experiencing, and again seeing some very, very high prices paid. $754 a metre is a record for that area out in Campbellfield. Maybe a bit of a premium just due to there being adjoining three lots, but again, looking to invest, looking to apportion some of that to their own operation, and then looking to develop and do something with it is something that we're seeing a lot of. There was a property that we've just looked at very, very recently in Modal Court in Deer Park, which is probably very similar to this, where 13 architecturally designed industrial sort of office warehouses. The gross sale price on all of those 13 was $4.75 million. So all of a sudden, that's the type of things that people are looking for, acquiring a bit of land, owner occupying a proportion of it, and still having that potential to make a pretty penny, so to speak, on the back of it as well. So again, just another reason we're seeing some records not only being not only records seeing at a rate per square metre on a completed product, but even at the land, which obviously makes sense, and that's why we're seeing such high prices from an end product perspective as well. There's just some information that will that you'll get this pack anyway at the end, but just we do have a number of different property insights that we provide, not only on industrial but across all sectors and residential. But yeah, I think my time's up, but I'll pass on to Simon. Thank you very much for that.
Now we have Simon. Simon actually flew in today from Sydney. Simon's the head of distribution at Avari Capital Partners. And Simon has over 20 years experience across equities, derivatives, fixed income and property. He is a former senior investment and advisory professional from Macquarie Bank, AMP, CBA and Westpac. And also from Avari we have Volker, also coming from Sydney, Robert from the Melbourne office, and Leo as well. Of course, Margaret. So if anyone has any questions, feel free to direct them to Avari team as well as NAB team as well. So we'll have Alex.
Thank you. All right, thanks very much for having me. It's great to be back doing face-to-face meetings. It's been quite a while during COVID, and most of you I haven't met in the past, so it's great to meet people in the flesh. I'm only going to keep you for about 20 minutes, and then we can have some questions after. I think we're going to have a bit of a Q&A up here. So enjoy the foods. What I'm going to talk about for the next 20 minutes is value-add style investing in industrial. So we've heard just then a lot about the industrial market, and it's a pretty hot market at the moment, and I'll touch on that in a second. But the topic or the theme of my presentation today is about adding value, not waiting for growth. So I'm just going to cover the industrial market, a little bit of our thoughts on where we see the industrial market and what we're looking at, our investment strategy and the type of assets that we're going to try and acquire in this fund, the seed asset that we've already acquired, and then I'll talk a little bit about Avari, which you probably know most of that already. So, hasn't the market run too far? That's the first question I get as soon as I mention this. The fact that we're starting an industrial fund when you can see charts like this with yields going down to record lows. And it's definitely a good question to ask. So obviously industrial, we've just heard industrial has had a really good run. But I'd say there's really two ways that you can make money in any type of property. So you can make that through cap rate compression or yields going down, which is what we've seen. And the other way is through rental growth. So your income going up, which is really the reverse of the cap rate compression. So we would definitely argue that the cap rate compression story is over. So people aren't going to accept less than, we heard 3.25% is the low. You can get 2% now in a term deposit. So are people going to accept less than 3.25 for an industrial asset? Probably not. So I think that story is over. In the past few years, you really could have bought anything in the industrial market and made good money because it was like buying bonds. The interest rate kept going down, the yields were following it. That story's finished, exactly the same as the bond market. But there is still good opportunities to make money in this market, which is what we're going to cover. And so I would argue the people who have just bought that asset at 3.25% yield, do they expect to just earn 3.25% yield for the next 5 years? Probably not. So what they're banking on is rental growth to come through into that asset, which is going to boost their cash flow, and then effectively they can sell that for a higher price. So yeah, we've talked about the industrial market. It's been a hot market. A lot of that's really been driven by a weight of institutional capital. So industrial used to be the unloved child in the property space. It's now probably the hottest market in the institutional capital. So we talk to a lot of offshore investors, big super funds, Canadian pension funds, those sort of groups, and they're all chasing Australian industrial property. A lot of the reason for that is stable environment. Interest rates here are still higher than the rest of the world, so that and yields have been higher here than the rest of the world. So there's been good money to be made. And then also the e-commerce boom, it's definitely not going away. So the other point I would make is that, so this chart here, you can see here, it's not the greatest chart, but you'll be able to see it better when you get the pack, is that in the last 10, 15 years, Australian industrial property, we really haven't seen any real rental growth. So what I mean by real rental growth is basically rental growth has matched inflation. So there hasn't really been any real rental growth, but we are now starting to see that, and that's why I think people are still out there buying industrial property, is because you're really starting to see that rental growth coming through. So JLL, I saw your presentation 4% last year. JLL said 10% industrial rental growth in the past 12 months. So that's what that's part of our strategy, and that's what we're looking forward to. But I think that is really starting to come through, which is a really big change in the Australian market, because we just haven't seen that. In the US, they had 16% rental growth in the industrial market last year, and their vacancy rates are actually higher than we have in Australia. So national vacancy in industrial is around about 2%, which is, it's never been that low. So there's huge demand, as we've just heard, for these properties. The other chart here is just showing the difference between prime and secondary. So the prime grade, as we've heard, prime grade in industrial is different to residential. So the big sites that are way out, huge distribution centres that are going to be rented by Amazon, that's the prime stuff. That's what all the big super funds are chasing, because they can outlay $50, $100 million on a single asset. That's not what we're chasing, so we're going to talk about that in a second. So that's a point to remember there. Go too far. Okay. So the next thing anyone's going to mention to me, I'm sure I will after this, is rising interest rates. Rates are obviously rising. Why would you be buying industrial, 3 or 4% yields when you've got a rising rate environment? I guess the question to ask to that is why are interest rates rising? So are interest rates rising just because, I don't know, inflation? That's one reason. But because asset prices and rents are increasing, that's a major reason. So they're not just rising of their own accord, they're actually rising because asset prices are going up and rents are going up. A major part of the CPI is actually rents. So I would argue that in an inflationary environment, do you want to have your money sitting in cash, or do you want to have it in real assets? You probably don't want to have it in Bitcoin, as we've seen in the last couple of days. So I would definitely argue that real assets, whether that be real estate or other types of real assets, is a good inflationary hedge, and we think it's a good place to have your money in an inflationary environment. Interest rates, you have a look at the yield curve at the moment. The market's really predicting strong growth in rates in the next sort of 2 to 3 years, and then really flattening out. But I'd probably argue that interest rates have been historically way below where they should have been. So they really should have been at 2%. The cash rate should have been at 2% for the last 3 or 4 years, not at effectively zero. As you've seen now, not the cash rate, but term deposits, which is what most people really associate as their risk-free rate, that's jumped up to about 2%. And we haven't really seen asset prices move that much in relation to that. So I really think that cap rates have been historically too big of a margin above where the interest rates were. So generally there's about a 3-4% spread between interest rates and cap rates. That's been about 4.5%. So there's a bit of space to go there before prices really start moving. But even now, buying commercial property on a leveraged basis, so even if you're buying at market, just sitting on it hoping it's going to go up, which is not what we do, if you leverage that up and you're getting 5 to 6%, it's still a lot better than a term deposit I had here at 1.5. They're now 2, but it's still better. The other thing is, inflationary hedge is one thing, but in industrial property, it still has a lot of structural tailwinds, as we've heard. So super low vacancy. E-commerce, it's definitely not slowing down. So Australia is way behind the rest of the world in the uptake of e-commerce. So we're getting there, but we're nowhere near the US or China, and so we've got a long way to go there. And as we've heard before, there's heaps of demand for this space. So there's a lot of structural wins there behind you. Increasing focus on delivery times and avoiding supply chain issues. So COVID's obviously stuffed up a lot of businesses with the supply chain issues. So now companies are taking on more space so they can hold more product here in Australia rather than having to get it from offshore. So if there are any future problems, then they can satisfy those demands from customers quicker. There's lower capex and incentives in industrial than office. So in some of the examples we've seen before, and some I'll show you later, generally there's almost no incentive level in industrial property across the board. whereas in office, if any of you are familiar with that, we can talk about it after probably. Generally, incentives are sort of 20 to 30% at the moment, whereas in industrial, generally what you pay is what you get. Limited supply, and then population growth is definitely one thing that's still coming through, so that's a key focus as well. So in conclusion, I think cap rates probably will rise. We're not saying that they won't, but we think that's very much likely to be offset by rising rents over the next 5 to 10 years. So industrial, we think, is definitely the best place. If you're looking to invest in real estate right now, industrial is the place to put your money. So our investment strategy is targeting value-add style assets rather than buying at market. We'll talk a little bit more about that later. And then targeting also secondary grade assets. So we heard before that the secondary grade assets haven't run as far as the prime assets, and that's what we'll be targeting. Okay, so the types of assets that we're looking for, they're not the big shiny flash assets that you see out west. They're the ones that are closer to the CBDs. They're not as good looking, but they're probably ideally surrounded by residential areas, and they're the smaller industrial sites where potentially in 10, 20 years time they might be rezoned to residential. But there's multiple exit points. You might see a Bunnings built on that site in 5 years time rather than in an industrial facility. So what we call those multiple exit points. So they're older facilities, so they're generally probably 15 plus years old. But the thing is, with industrial compared with residential or commercial or office, is that people don't care about the building as such, as much. So it's more about the position. So if you get on a busy road, close to freeway exits, that's much more important than what the actual building looks like, because it's really just a big shed. It's 4 walls and a roof. So what we're trying to find is those older ones that do need a little bit of work. So ideally we'll be buying them. We'll wait till the lease expires. We'll get the tenant out. We'll do a bit of a refurb, painting, fix the roof, put the proper sprinkler systems in, maybe some solar panels on the roof, that sort of thing. Nothing too adventurous. Get in a new tenant and increase the rent. That's the basic strategy. So the idea is to acquire up to about 500 million or more of these types of assets over the next few years, and then sell the whole portfolio as one. So there'll be a national portfolio, so there'll be a diversification of lease profile, of tenants, industries, and obviously location. And there'll be a different management style for each area. So the industrial markets are actually quite different. So Sydney, Melbourne, they're quite different. So there's a whole pack which I'll send you. I won't go into too much detail right now. But we've got a different approach which we've detailed very thoroughly in the investment pack. Cross-collateralization. So the reason we're putting these all into one pot rather than doing them as loan by loan. The bankers here will tell you that if we do them as single, we have done plenty of single asset deals in the past. With industrial and particularly this strategy, what we want to do, as I said before, is get rid of the tenants and make it look nice and get in new tenants. You can't really do that if you've got a bank loan, because they're worried about the serviceability. So if we have these all grouped together and there's multiple in the portfolio, we have the ability to be able to do that. As taking on the leasing risk there, let's speak louder now. So what we're looking for is mispriced opportunities. That's really a key theme. That's why we've got people out on the road looking at multiple assets. We've got about 20 assets we're looking at right now in this portfolio. We're combing through looking for the specific deals. So we're not just rocking up, buying things at auction and bidding at market. We're really looking for the undervalued opportunities. And when I show you the seed asset that we've bought, it'll become really clear what type of assets that we're actually looking for. So we're looking for, as I said, those older style properties where we can actually get in and do something. We don't want to buy at market and just wait for it to go up. We want to get in there and do something. We want to either, we want to increase the rent, we want to get the rent back to market, we want to add more space, we want to do something. There's got to be a strategy to it. It's not just buying at market and hoping that it's going to go up. So a lot of that is really around rental revision. So there's a big difference between rental revision and rental growth. So what I mean by rental revision is buying something where they're charging, as I'll show you in a minute, $48 per square metre rent versus the market is really $80. So when you look at the asset that we've just bought, we bought that on a 4% yield, but they're paying basically 50% of what they should be paying as a rent. So the yield doesn't really it doesn't make sense to quote a yield on that asset. It really should have been bought at an 8% yield if they were paying the proper rent. So that's the sort of thing that we're looking for. As I said before, some of them might be able to get rezoned. You might be able to put a Bunnings or a IKEA on one of these sort of sites, or you might potentially be able to get it rezoned to residential down the track. That's not really, we're not banking on that. That's not our core thesis. But some of these assets probably will be able to achieve that. So actively adding value, not waiting for growth. So the way that we actually get, so our target return is 15% per annum. The way that we get to that is the initial yield, the rental revision, and then the natural rental growth. So we do have natural rental growth factored into our model, which is just the CPI. So natural CPI rental growth is about 3% per annum. Some development upside, so some of these assets we'll be able to add space. We might be able to knock them down and build small strata units, sell those off individually. And then the last one is the portfolio arbitrage, which I'll go through in a bit more detail. So portfolio arbitrage, we've seen recently, there's been a few transactions recently where a lot of these big super funds and big offshore pension funds, they want to deploy capital in this space, but they don't want to stuff around with $10, $20 million assets. They want to deploy $500 million, $1 billion in one go, and they want it to be all nice and pretty and done and leased. So they want to, exactly the opposite of what we're doing, they want to do. So they want to get in and they want to buy something that's got a 10-year lease, it's all nice, they've got the roof done, they've got the solar panels, everything's done, and they just collect the rent. So our strategy is to get in there, buy the undervalued asset, do the hard work, and then sell it to them. But if we sell a whole portfolio together, you can actually achieve a premium on what those actual assets are worth individually. So there was a recent transaction, Blackstone sold this portfolio. It's a big portfolio, 3.8 billion. The cap rate was 4%, but I'll send you this and you go through it in a bit more detail. But I mean, almost 30% of those assets in the portfolio, they bought at sort of 5 or 6. They're really trading at 5 or 6%, but they sold the portfolio at 4%. So there's that arbitrage when you can group a whole lot of assets together just to make it easier for these big investors. Okay, so this is the seed asset. So we've only got one asset in the portfolio right now, but as I said, we've got about 20 assets that we're actively looking at right at the moment. So this is an asset in Thomastown, in the north of Melbourne. It's an older style building. It's surrounded by residential, so right across the road there's about 100 apartments. This potentially in the future could be a Bunnings or something like that, but we're definitely not banking on that. The key thesis of this one, so we actually own another asset in Thomastown just down the road. The asset we own in Thomastown, we bought about 18 months ago, and we've just done the rental revision, so we've just done what we're planning on doing with this one. We've increased the rent from about $70 per square metre to $105 per square metre. This asset that we just bought, they're paying $48 per square metre. It's in the same suburb. It's not as nice a building, the other one's a bit nicer, but if we can assume that we're going to get this to $70 or $80, that effectively doubles the value of this asset without really doing anything. So we will get the tenant out, we'll paint it, we'll put the sprinklers in and all that sort of stuff, but that's not going to cost us a lot of money. So that's the perfect style of asset that we're looking for, is this older style asset. The land rate on this is only $600 a square metre, so it's very, very cheap on the land rate. So we have bought it well, and that's our job, is to find more of these style assets. That's probably a bit too much detail there, but that just goes through the tenants that are in there and shows you the covenants they've got. So this is the most important thing, is market review. So that means when the rent, even though they've got an option to extend this lease, when that lease comes up, we get a evaluation on what the market rent is, They'll either have to pay that market rent or we can get them out and then we can do the strategy. This is the other thing I want to show you. These are just two recent examples of recent lease deals. So you can see this one's in Camberfield, that's $89 a square metre, and that one's in Epping, is $105 per square metre, and there's no incentives. There's no incentives on that, so they're actually just getting what they're getting. There is an opportunity to increase that face value and give some incentives, which is also a strategy that we will be undertaking. So what are the risks? The major risk in this is obviously the market risk. Cap rates blowing out and the whole property market collapsing. We obviously don't think that's going to happen. That's why we're investing our own money in this portfolio as well, and why we think that industrial is a good place to be. The leasing risk, we've got Volker here, who's our leasing expert. He's down here all the time and he's all over it. So, and as we've heard before, if you do lose a tenant, it's really not hard to find a new one. In one of our other assets in Altona, our tenant left during COVID. Within a week, we had 3 different tenants trying to take that space. So it almost became a bidding war for the leasing space, which is unheard of. Tenant default risk. I mean, we have risk mitigants built in for that. You've got bank guarantees and things like that. So it's more about being able to refill the space. Development risk. We're not going to be doing a huge amount of developments, but we have a very experienced team in-house that we can handle developments. And when I say developments, we're not building 20-storey buildings, it's building a shed. It's not particularly difficult. COVID, hopefully we don't have to keep talking about COVID anymore. Hopefully it's the last slide I ever have to put COVID on. Even during COVID, asset prices have definitely appreciated a lot in this space, and I suppose industrial's probably been the best place to be in during COVID because all the businesses mostly could keep operating. So I'll just finish up very quickly because I'm running over time here on the manager. For those of you who don't know us already, Avari Capital Partners, we manage about $1 billion across real estate and debt. So we have a debt business where we lend to other real estate owners, and we have an equity business which I'm talking about today. So we manage about $1 billion in. We have all types of real estate. So we've got industrial, office, residential, land subdivisions, and then on the lending side, we've got a fund where we lend out like a monthly income strategy. So we're very experienced in this field. Our main thesis is, as I said, about adding value. So we're definitely not just buying anything at market and hoping that it goes up. We've got a strategy, we've got an exit strategy, and we know exactly what we're going to do when buying that asset. So we look at a hell of a lot of these assets, probably about 1,000 assets per year. Out of those, generally we'll buy sort of 3 to 5 assets. So it's a very, very selective process, and we're putting our own capital behind each one of these deals. This is the major team. So quite a few of us are here. Alan's the Chief Investment Officer and the founder. He's not here today. Margaret's sitting over there, CEO. Terence is our head of property. He's an architect, and he's probably delivered over 100 assets. There's myself. Isolde is the head of capital transactions. Volker, sitting down here, is our head of asset management, so looking after all the leasing primarily. And then Rob, over on the left, is our head of sales and leasing, so doing a lot of the residential stuff and the leasing for our commercial assets. Very briefly, a couple of examples of assets that we've turned around recently. So this has been a really good one. I wish I was an investor in this one. Unfortunately, I wasn't. This is one industrial site we bought in Banks Meadow, which is near the airport in Sydney. About 2 years ago, we bought this. We bought it for $8.5 million. We sold it for just under 14 months later, and it was spitting out 11% yield during that term. So it was a fantastic result. As I said, we worked very hard. This asset went to market at an ATO auction 2 days before Christmas. There was no other fund managers there except us, so we managed to pick it up under replacement value, very, very cheap, for about $2,000 per square metre when the market was at 6 to 8 then. It's now about 15, something like that. So
this is the deal once in your life.
Once in a lifetime. Don't expect this one. Let's move on from that one. The other one is in Port Melbourne. So we bought that one as an industrial asset. We actually did manage to get that rezoned into resi. So we're just about to start building a 14-storey residential building there. So our team will be managing the build on that. We have external builders, but we'll be the project manager on that. So Rob is already. Have we already sold most of that, Rob?
Yeah, over 60%.
Yeah, so Rob's done all the sales off the plan for that asset. So as I said, we've got the team in-house to be able to handle that sort of size building. So building a shed is really not going to trouble us too much. These are the other two that we own. So these are the two that we own currently. This is the one in Altona, and that's the one in Thomastown. So the one in Thomastown, as I said, we bought that. The lease was around $70 a metre. It's now $105. So yeah, when we bought it, we thought if we could get that up to about $80–85 a square metre, we'd be doing pretty well. We've just now achieved 105. So that's the rental growth that we're starting to see come through. This is the little one in Altona. That's been really successful as well. That's the one we had the bidding war on for the leasing space. So that's all for me. There's a disclaimer there, and you'll get this pack as well, so we'll email this pack through to everybody. So yeah, more than happy to take some questions. I think industrial is going to be definitely a big winner in the next few years to come. Even though it has had a strong run, there's plenty of opportunity to make money. And I think if you back our team, we will find the good assets to buy.
Any burning questions? No?
One question, please. I was wondering if the IRR 15%, does it include a monthly distribution at all?
So quarterly distribution would probably be about 3 to 4%.
That's on top of the IRR?
No, that's included in the IRR. Yeah. So this is primarily a capital growth story rather than an income play. And because we will be having some leasing, if we get a tenant out, we do a bit of a refurb, get another one in, that might be 3 to 6 months. So even though some of the assets will be generating good yields, some of them won't be, so the mix will probably be about 3 to 4%.
But that's after fee.
That's after fees. Yeah.
What's the model next horizon for the fund? Like, what's the timing in terms of
So it's open now. We're taking commitments now. I think we've got about 15 mil so far. We're looking to raise between 20 and 50.
Yeah.
And we need the way you can do it is either give us all the money and we'll park some of it in our loan fund, or you can just do a capital call. The first call will be 15th of June, which will be between about 10 and 20% of whatever you want to invest. And then hopefully we can draw the rest over the next 6 to 12 months.
Simon,
Yeah.
you mentioned capital growth. You're talking 1, 2, 3, 5, 10 years. But how long?
4 years. 4 years. Yep. So the idea is to build this portfolio up to a decent sort of institutional size, and then we can sell the whole portfolio in about 4 years to achieve that arbitrage.
I was just curious, that rent review that you did up in Thomastown, or wherever it was with the incumbent, obviously.
Yes, it was. Yep.
Why the heck do you want that? Obviously, happy to sit there.
Yeah, there's actually a pretty good tenant, that one. That's the leather company. So they make leather for cars, like really high-end leather stuff for cars.
They are actually wholly owned subsidiary. Not wholly owned, it's like 78% owned by a leasing company. Yeah, so during the COVID, apparently they are not SME, so they still pay good rent. Yeah, so that's
Just another question, geographically, so exactly where does the west start? Is it west of Marine, or is it anything west of the coast?
It's a really challenging one. Camberfield's still classified as northern. When you're looking at west, it's really from Westgate Bridge. It sort of tapers down towards Geelong, and then takes up, Truganina, Tarneets, all those sort of areas. So it sort of ends. Camberfield's still classified as northern. Some people refer to it as northwest because they try and capitalise on some of those western rates that we're seeing at the moment. But it is pretty much centred from Westgate Bridge down the Geelong Highway, give or take, 5 or 10 k's either side of the freeway, to be honest with you. That's the main corridor, western corridor.
Simon, just a question. I'm very new to industrial
Yeah.
real estate. Just for residential, for example, you know what's the blue chip real estate? You know,
Yeah.
in the school zone or close to shop or close to transport.
Yep.
For industrial real estate, is it look at how you're going to do with that real estate or how close to the public transports or?
Yeah, so a lot of it's
Ports
around
or-
distribution hubs, so freeway exits and things like that. So, like the Thomastown area, there's the new ring road,
Yeah,
the
you've got the ring road, yeah.
northwest,
Yeah.
northeast link, northeast link.
As well, yeah.
That one. So yeah, that one will pop out right near there. So it's things like that. It's more about how can you get a truck in there quickly, in and out.
Yeah.
And then also being on a busy road is quite good. If you're on a corner block, is quite good. So it's a bit different to. It's kind of opposite to what you'd want as residential.
It's really around accessibility. So, you know, the clearance heights, you know, all of those sort of things are really the differentiator between, you know, primary sort of product and sort of that secondary stuff. That's probably what you're talking to, alluding to. Some of the older stuff, you know, doesn't have high clearance rates. You know, the roller door heights are another thing that's, especially now with the size of some of the trucks, you know, you've got to be able to accommodate a lot of that stuff. So, you know, even accessibility, road accessibility, if you've got a big B double and you can't, you know, back
can't
it in,
turn it around
then so there's a lot of these things where, as an investor, you probably think, oh, this seems pretty standard compared to the other one. Why is this rate so different to the other one? It's a lot of those sort of nuances between properties that makes one more appealing than another. So it is very different to school zones and all those things, that's for sure.
So in regards to area, for example, you're talking about Thomastown, which is in the north, and Avari, which is in the east. In terms of the area, is there any difference in between the square meter rates?
Yeah, there definitely is. So the
Yeah.
prime grade areas, which are the ones, the big distribution centres that Amazon would hold,
Okay.
you know, they're sort of $3,000 a square metre, where these are $1,200 a square metre. So it's actually considerably cheaper, but it's closer to the city.
Okay.
So it's kind of the opposite of residential.
Yeah. Okay.
Yeah, and a lot of those things as well. It's really about the product. So you're buying on product, irrespective whether it's in southeast, west, north. It's the requirements of that person buying it is the main data. But yeah, whether it's 30 kilometres southeast or whether it's 40 kilometres north or west, that's not really relevant. It's about those linkages they've got to airports and distribution centres and all those sort of things.
I've got a question for Alex, please.
Yeah.
It comes in two parts. First being 1% of cash rate lift, how much of the yield do you feel like is going to uplift as well?
Yeah.
Second part being, do you foresee much of Blackstone to ESR transactions in the near future? Do you see a lot going on?
I can give my personal view. This is not NAB's view, but if we saw a percent increase, I think it's about the rental story. I think a lot of the yields we're going to see increase is more based on that, because, as I said, if you can get money through a term deposit, why would you pay 3% in that? So even as a general rule of thumb, I think with rents increasing and the cash rate increasing, I think even if you just set a percent for a percent as a very, very conservative approach, that'll probably give you an indication of probably where they'll need to stabilise at. And I think, you know, that 4 or 5% is probably, you know, 5%, sorry, is probably more realistic for these sort of type products in the short term. That's probably answers your first one, but again, just my view, not NAB's position on that. And as I said, you know, I think what we've both sort of alluded to, that rental growth can't be underestimated. And a lot of people say, well, even if the market did absolutely collapse, you know, what would we do with all this product? That would probably even put, arguably, even more pressure on our established stuff, because there's not as much new stuff coming to market. So with that, you know, whatever is available, the demands would still be there for a lot of the product that's, you know, currently established or is near completion. So that probably answers the first one. On the second one, I think, you know, I don't work for Avari, but I definitely think that people will be waiting to 2025 realistically for a lot of those examples to come in. I think this is a bit of time to just wait. I don't think we'll see too many of them. I think this is a time that people have consolidated, and I think they'll see over the next 2 or 3 years will be 2025 in my mind will be when things start to open up a little bit, and you'll start to see a little bit more, a few more transactions taking place from those examples. That's my opinion anyway.
Thank you.
Yeah, thank you.
Two questions. The first one might be for Simon. Apart from your seed assets, how many more similar products or assets you are looking to acquire, and what's the time frame for that?
Yes.
And if you don't achieve your goal, what's your fallback position?
So I guess it depends on how much we raise for the first raising. Then whatever we raise, we'll go and spend that over the next 6 to 12 months. We may potentially do another raising down the track if it's successful, and we still think the investment opportunity is there. So it really depends on how much we raise. But say we raise 25 million now, that means we can buy probably 5 or so assets, maybe 5 or 6 assets. And then we might do a second raise after that. So yeah, it's kind of hard because it depends on how much we raise and also what the price of the next asset we buy is. So that one's quite small, I would say. Probably 10 to 30 million would be the range that we'd be looking at. Yeah.
And my second question is, without getting into your commercial secret territory, I'm just wondering, what's your competitive advantage to make sure? Alex mentioned there are 99, competitive bidders there. What's your competitive advantage to secure the ideal assets you want?
Yeah, it's a good question. I guess we've just been around in the market a long time. We know all the agents. A lot of the time, you just have to be out there talking to them, looking at every single deal. And that one, a lot of pretty much all the industrial ones that we've bought, if you can pick them up from local agents rather than the big CBREs and JLLs, those sort of agencies, you can quite often get a bit of a bargain. I think also with rates going up and a bit of dislocation in the market, it could be quite good. A lot of these assets that you're buying, they're from owner-occupiers, so they might be from someone who started the business 20 years ago. They made a lot of money from the property that they own, and they sell like exactly this one. They're the tenant in the property, and they're charging themselves $48 a square metre, which they think is a reasonable rate. They don't really know that they should be paying double that. So they say, okay, $48 a square metre divided by 4%, that gives me whatever the value of the property should be, and they're happy with that. So you're not really generally dealing with other institutions. It's more sort of mums and dads really. So yeah, quite often you can pick up a bit of a bargain. But that one is a particularly good one. They probably won't all be as good as that, to be honest. But it's really more about just being in the market, being really active, and looking at a lot of deals.
Thanks.
Yeah.
I was just wondering, in terms of the deal you're looking at, obviously this one's about 8.8 million.
Yep.
What sort of average price of the transactions you'll be looking at? Is it all going to be about 8 million, or are they going to be different kind of?
Probably between 8 and 30, I would say.
And the total portfolio will be around 500 million. Is that property value or net value?
Yeah, property value. So if we get the property value up to about, so in this very first raise, we'd probably only buy, say, $60 million worth of assets, probably in the first pool. Then we might tack on some more after that. Yep. So if we can get the whole portfolio up to about 500, then it becomes more like an institutional grade portfolio.
Yeah, because the time frame is about 4 years. Obviously, after this raise, you might do another and another.
Yeah, so I think we'll probably just do maybe two raises, and then we'll close that fund.
Yep.
And then we might start another fund once we've already done the work on that one.
I see. And the unit price will be the same?
No, it'd be adjusted. Yeah,
okay.
yeah.
Thank you.
Yeah. Any others?
Okay, I'll go for it.
Yeah.
Percentage wise, how much of this would come under, say, for instance, superannuation in mum and dad stores?
Sorry, I didn't really
Like, for instance, with that purchase, that 4-year one, that 50 million.
Oh, yeah, yeah.
With that, how much percentage of that would be in, say, in superannuation, or was that none at all in super, or was it mainly just investment?
Do you mean the people who are putting the money in?
Yep.
I would say mostly it's self-managed super funds.
Self-managed.
Yeah. And family trusts, self-managed super funds. Yeah. If there's no more, we'll be hanging around after, for quite a while. So if there's any more questions,
Thanks
feel
so
free
much.
to come up and ask us any questions.
Enjoy.
Yeah. Thanks very much.